Hello traders, today is Monday the 15th of March 2021. I'm Neville Hornsey, market analyst for YouTrading, and I'm joined today by
Joel Frank, and also market analyst for YouTrading. How you doing, Nev?
very good. Long time no see, so it's glad to be back with you.
Yeah, I mean, it's been a bit boring, hasn't it, really, for both of us? Like lockdown Britain. Yeah, man, we were just saying before we started, since we last spoke, when did we last speak? December. And we were just saying how much markets have moved since then. It's insane. What you say, you talk about oil.
Yeah, so last time I remember us talking, we thought oil should be tagging the $50 mark. And today, you're looking at the charts and it's a lot higher. So that's been amazing to see the energy complex go as high as it has so far.
Yeah, it's been absolutely insane. I mean, I don't know, do you want to bring up the chart? We can have a look.
Yeah.
If you're looking at any technical setups, but I mean, the main thing I'd point out is we had this range going in 2019, and the bottom of the range was around the 50 mark, and the top of the range was around the 65 mark, and we were kind of oscillating between that throughout 2019. But we've managed to rally from the bottom of that range all the way to the top and above the top of that range. We did it in like 4 weeks. It was insane.
No, exactly. Yeah, I've got the monthly chart up now, and that little range that you're talking about is we're definitely popping out the top of that. And if March continues to go higher as it is at the moment, then we should be testing 2018 highs, and then a gap in the sort of price action, which should take us all the way back up to 100 should we get above these like recent highs.
Yeah, it's almost like, technically speaking, it's like clear air when we above that 2018 high.
Yeah, exactly. And having gone through the sort of resistance from 2018 to 2019, if I just put a box across it, when we last spoke, getting above the sort of 50 mark was quite immense, really, the amount of trading that has been done there. And now it is just whether or not we can get through this sort of the range high before tagging the 2018 highs here. So $78 looks really possible at the moment with this amount of momentum. So 1, 2, 3, 4, 5 months of momentum straight up, and it doesn't look well. We got the economy's coming back online, so more gasoline, more jet fuel, more just more petroleum in general. So amazing.
I think it's definitely going higher. Like you say, technically speaking, we're looking pretty bullish, but fundamentally speaking, US economy, Europe, hopefully in the northern hemisphere in general, we're going to head into summer, which means the prevalence of the virus is going to go down, but also the rollout of vaccines, which is still not going great in the EU, unfortunately for them, but it has been going well in the US and the UK. And the EU will get there eventually. So we're looking at the end of the pandemic, hopefully, which means the end of all these restrictions, which means, like you say, more gasoline fuel usage, because people are going to want to go on holiday again. They want to be driving around, even if it's just in their local areas.
Yeah, so I think even me personally, just like a 5-minute drive out with the family is enough to get away from these 4 walls. So you can imagine the summertime and the driving season sort of really kicking in, and that gasoline usage, going up. So fingers crossed that the Saudis and the Russians and the Americans can come. We don't want to see a repeat of June sort of 2020 sort of contracts. So.
Yeah, I don't think that's going to happen. Even if they, because the Russians are a bit itchy to start pumping a bit more oil, whereas the Saudis are happy to kind of keep it restricted and let the price go higher. So we might see a bit of conflict in OPEC over the coming months, and that might slow the ascent. But I don't think it would derail the rally, if you know what I mean. Because like you say, the demand side's just too strong.
Yeah, definitely. And, in fairness, the last 5-6 years, this sort of price level has suited a lot of people. It's above 40, and most people can make money at these levels. So
yeah, very true. Very true.
What else has been on your radar recently? Yeah,
I mean, one that's been interesting me a lot has been the dollar, really, or how it's been choppy, but it's the tables have turned for the dollar definitely since the start of this year. You remember we're looking at all this massive dollar weakness into the end of last year, and I think one of the key factors well, definitely one of the key factors that has enabled the dollar to kind of consolidate / move a little bit higher, is this move higher in US government bond yields that we've also seen. That's because that's making the dollar more attractive. You know, people want to sell government bonds in Europe or in Japan or wherever else, and they want to buy US government bonds, and obviously you need to buy dollars to do that.
Yeah.
So
the amount of negative rates and low rates around the sovereign sort of nations. The dollar being like a positive rate already, and then these increasing rates, it's definitely more attractive to be in dollars currently.
100%. I mean, actually, the weird thing with the dollar is that real rates, when like the inflation adjusted government bonds, are actually very, very negative in the US still. I think they're actually more negative than they are in Europe because inflation expectations are that much higher. But real interest rates have been rising as well, and it looks like they're going to continue to rise. So, I mean, all this risk appetite's not good for the dollar, but these rising rates, I don't know. I think we could see the dollar continue to kind of grind higher.
No, definitely.
Is there anything?
I was watching the dollar versus the Chinese yuan, and you know, for the time we've been talking, it was like going down, and then after the Chinese New Year, there was like a bit more of a dip down, but then it bounced back up. But the dollar index itself didn't do that sort of final dip. It has been sort of making higher lows. So there's definitely more demand coming into the dollar of recent time, the last month or so.
Yeah, definitely. It's an interesting one because literally it's amazing. You see this every year. Do you remember how you get all the big banks and stuff? They put out their yearly notes, which are like 100 pages long, and all of them calling for weaker dollar. And within a couple of weeks, it's just like ripped up every single year. All their forecasts.
But I think like the underlying sort of conditions in the US is lots of stimulus, so lots more dollars in the system. Then there's the ever larger deficit, like the debt that's getting bigger and bigger, and then you've also got like a large trade imbalance as well. So I think personally, I thought 90 was going to actually give way, and we were going to see a lot lower in terms of like prices of dollar. But of recent times, with the yields rising, then that has obviously scuppered that trade currently. But whether or not the yields can stay rising and higher as they are. Like
all the stuff you just said is still completely relevant, like bearish dollar arguments. And I think if it wasn't for this recent move higher in yields, then dollar would have created probably. It probably would have hit that low. Where was that low from 20? Can't remember what that 2016. I think it was at 88.25, or it was somewhere around there. A low from 2016. We would have hit that definitely, but yields have kind of saved the dollar really.
And on the flip side for the bullish sort of argument, what I have been like reading is that if there is a shortage of euro dollars, like the dollars that are outside of the US themselves, but like you said, like people need dollars to trade and things like that. It sort of smooths all of that. If there's a real shortage of US dollars, then there's going to be a greater demand for dollar. So watching the euro dollar sort of rates as well is, showing that the yields are going higher there as well. So we could be a stronger dollar, which, it's just whether or not that plays out, or whether the sort of central banks sort of intervene and something happens in that market.
Yeah. I mean, I think the whole theme about the Fed now is more, well, I don't know, because our markets work off of narratives which are always changing. But I think the narrative with the Fed now is probably more dollar positive than it is dollar negative, just because I think the Fed have reached peak dovishness. And if you're not going to get any more dovish, I don't think you can really drive any more weakness in your currency. Do you know what I mean?
No, definitely. And every central bank has been sort of saying there needs to be more fiscal sort of support. There's like like you said, they've come to the end of the road of what the central banks can do themselves to do this inflationary sort of trade. They're now talking more about letting inflation, rise and just overheat a little bit. But, the sort of sentiment's going towards employment. And at the moment, the US employment participation rate is like its lowest since the 1970s or something.
Yeah, it's not good.
The Fed's policies aren't really helping that mandate, so they're going to need help from fiscal and all that type of thing. Yeah.
And the US, they're getting the most help from the fiscal authorities, aren't they? It's like Biden's 1.9 trillion stimulus package just passed. They're talking about this massive infrastructure package, which they're probably going to pass because it actually has quite a lot of bipartisan support, because there's a lot of people concerned about how they need to invest in this infrastructure so they can continue to compete with China. But then if you compare that to the Eurozone and the UK and other countries, there is fiscal support. Like they've got the EU recovery fund coming through, and we just had the budget, which had a bit of fiscal support. It's nothing compared to what they have in the US.
No.
Yeah.
The amount of trillions of dollars is crazy, isn't it? So,
it's mad. It's mad.
But I was just looking at a really long term chart, and the sort of 90 level on the dollar index, from like 1986 to, through the early 90s. Then obviously we had the 2000 rise through the dot-com bubble, but then it's gone back through the 90 a few times since. But yeah, like I said, 2018 lows, that was the low I thought which was going to give way, and then go back down to 80 or 77 and a half. But yeah, until these yields sort of give up their sort of bullishness. And I did read recently that the yields themselves, a lot of the 10-year selling has been those sort of like short-term speculators. So it'd be interesting to see if that is true and they are the driving force of the current yield rises, or whether or not it's like a bigger thing. But yeah, we'll see.
We'll see. And watching yields, I think, is going to be really important, because yields have also, this will be a good time. We can look across at stocks now as well. Yields have been driving equity markets as well. Like particularly this rise in long-term yields, like 10-year, 30-year, it's been really causing some pain in some of those big tech names and other sort of growth stocks. Like, you have these stocks which have a very high price to earnings ratio.
Yeah.
So they're more exposed to increases in the risk-free rate, which is basically these government bond yields. So like Tesla and a lot of these other big techs have just been getting absolutely smashed by this.
Yeah,
but then other stocks have been doing well, like industrial stocks and financials, like higher yields and stuff. So we've been seeing this rotation, but now the S&P is back at all-time highs again, isn't it? So in the end, positive.
I was looking at the pre-pandemic sort of themes, and the Dow Jones was the first to peak and then sort of drift off and then obviously crash. Then the Nasdaq was the first to sort of pick up as everyone had to stay at home. We were watching Netflix, using Zoom, and Amazon became obviously a thing. Tesla's obviously being put into the mix now as well across a couple of indices. And watching the recent price action, if the stimulus packages like 1.9 trillion goes, sort of drifts into these equity markets, there's no way you can sort of see them coming down, because the whole rise has been on the back of Fed and the fiscal sort of stimulus. But it is interesting to see the sort of patterns, the topping pattern on the Nasdaq, and whether or not I think at the end of this month, once we get through the sort of the plumbing sort of issues with the Fed and things like that, then if we can get through that without too much damage, then there's no reason why this stimulus comes into the markets and that goes back into like the Nasdaq. But at the moment, the Nasdaq's the only one that really sort of feels to me that it's just waiting for that straw that will break the camel's back. But I don't know. I think everything should be positive, and seeing the Russell go to new all-time highs, the Dow go there, the S&P sort of hover around those all-time highs. I think the Nasdaq's probably the US tech is probably the one to buy, really, because there's still room ahead.
Yeah, no, I completely agree. Like, the way I look at it is, I think over the next couple of months, maybe into sort of later on this year, the Nasdaq is probably going to underperform the other indices, because just like what you were saying about the fact that when we locked down, everybody was more reliant upon tech. When we reopen, people are going to be less reliant upon tech, which benefits the other equities. So, but that's not an out and out negative for these stocks in the long run. I think it's just a return to normality, and we're just gonna, we'll see the Nasdaq underperform for a bit, and I was just talking about the yields as well. That could cause them to underperform for a bit, but the rest is positive. The rest is positive. Like, we're going to have economic growth. We've got all the fiscal stimulus. We've got the Fed support. All of this points towards further earnings growth for these companies still. So yeah, I agree. Although I think we're probably in for a bit more underperformance yet. And I don't really know how long that could last for. Yeah. But in the long run, the Nasdaq will keep doing well, I think.
Yeah, if I just share the screen again one more time.
Yeah, sure.
The pattern that I was watching was obviously, like a bit like a head and shoulders pattern. It's at the very top of the all-time highs. So it's kind of, if there's going to be a head and shoulders pattern, this is where you want to see it as a reversal. Yeah. But obviously, every time there's a head and shoulders pattern, generally, where there's like a right shoulder and the head, that's where all the stops are. So if we start seeing the right hand shoulder at 13,353 sort of get tested, and the price accelerates through there, then we're definitely going to be testing like towards the head. And then if the sort of sentiment is that all of the other indices are going higher, then traders will want to like get new all-time highs again up to the 40,000. I think, like I said, like back in like maybe December about the oil, everybody wanted to tag the 50, and now it's just gone up to 65. Then if they get the 14,000 like level, then they'll probably, there's no reason, there's nothing above to stop them from getting anything else. So yeah.
And also, I think you said this just a second ago, like the stimulus checks, there's going to be a lot of people, a lot of retail traders that just, they see big tech names and Tesla and stuff, and they're just going to hit buy.
Yeah, like especially when Tesla's down at $600, and it's recently traded, a lot higher. So there's movement there as well to be made. And so we get through March because there's obviously some problems coming there with the banking and the SLR and things like that. If we get through all of that and the markets have survived, the stimulus is coming in. There's probably going to be more stimulus coming in with the Biden trying to, the infrastructure type bills. And like you said, if you're getting $1,400 directly to your account and you're staying at home with your parents still, then why wouldn't you put the $1,400 into the markets, which always seem to go up?
The last two times you got the check, it worked. It worked in the first one. You bought that massive dip, and your happy days, you nearly doubled your money. Then you got the other 600 check in January, and the market's not as much higher, but still higher, like you say.
And now you've had a dip. You can buy the dip now on the Nasdaq.
On the Nasdaq,
the Nasdaq, obviously raced up a lot higher. In terms of volatility, it went up a lot higher. The momentum carried it a lot higher than the others. So now you can imagine receiving a $1,400 check and thinking, I could buy the dip on the Nasdaq and get the Tesla, get the Amazon, get all of the big names that probably won't suffer in the long run. In the long run, definitely not. It's crazy. Is there anything else you want to talk about?
I don't think so, to be honest. I mean, like in terms of, we've been talking a bit more sort of over the next couple of months. Might be worth just quickly talking about this week. Like we do have a few key risk events coming up this week. What we got? We got the Fed. We got the Bank of England. We got the Bank of Japan. I mean, I don't think any of those events will be like earth shattering. Maybe traders want a little bit more from the Fed in terms of like people are worried about the rise in yields, and they want to hear that the Fed are a little bit more keen to do something about it.
Rather than just ignore it.
Which is basically what they've done so far, which caused a bit of a sell-off last time Powell spoke, and kind of like, the thing is, he's still very dovish, isn't he? He's very dovish when he talks about the labor market and inflation, but then, he wasn't very dovish on yields. So that'll be the main thing on Wednesday. And then I think we got US retail sales. That'll be a big one as well. And then other than that, US-China meeting of some top executives. Although there were some Chinese sources, I believe, overnight, or Chinese political observers talking about how they don't think it's going to really change much. I mean, why would it change much? Like the US and China are at loggerheads, aren't they? So
and with the again, it depends on who you listen to. It's like whether or not the trade, because obviously before COVID, it was all about the trade deals and things like that.
Yeah.
But if China has been buying stuff from America, and America, obviously needs to buy stuff from China, that was blatantly obvious when supply chains just sort of were destroyed. Everyone said, well, we do buy a lot from China. It's just like everybody needs China to like supply us. So it'd be interesting to see if trade talks do re-emerge once the pandemic stuff is like completely nullified. But
yeah, that will be interesting. I mean, it's mostly, I think they're going to be bickering about geopolitics, basically, aren't they? Like Hong Kong, Taiwan.
Yeah, Taiwan, China Sea and things like that.
Yeah. So, but that'll be a risk event. It could get a bit of choppy markets on that. But otherwise, I think it's going to be talk about fiscal stimulus, talk about the pandemic, most of which I think should be positive and should be risk appetite supportive. So, yeah, we're going to have to see.
Yeah, I'm waiting for whether or not the Fed in any way, or the sort of presser afterwards, discusses any legislative changes in this, the sort of the ratios, the lending, the reserve ratios, like that.
True.
Just whether or not, because they were allowed to expand their balance sheets because of all this stimulus coming into the markets. Now we've had another 1.9 trillion. Are the banks going to have to readjust and swallow that somehow, or are they going to get like an extension to this? Like, so we'll see. But that's
to the SLR thing, where they don't have to hold capital for their treasuries, isn't it?
Yeah, exactly. So
that's a really important one, actually. I'm glad you mentioned that.
Because if they do have to hold capital, then they're going to have to find some, which could be the sell-off in the sort of major equities and
or treasuries.
Or treasuries. So more treasuries. So but I think like you're right. Everything else I've read and all the other commentators have like been following think that the central banks have kind of got to that point now where they're just waiting for inflation, they're waiting for employment to come back. They're not going to change their general stance until that happens. So.
Yeah. I mean, this thing about the SLR requirements is more just a technical thing, really, isn't it?
Yeah.
But it could cause a bit of turmoil. Definitely could cause a bit of turmoil.
So we'll see. All right. Well, we'll see how that all pans out over the next week. And I guess I'll catch up with you next Monday.
Yeah, looking forward to it.
Excellent. All right, nice seeing you again. Take care.
Cheers, mate.
All right.